Holding a 100% stock portfolio in retirement. Sounds crazy, right? Because traditional wisdom says you should tap the brakes on investment risk in your golden years. But some ambitious retirees, well, they're keeping the pedal to the metal. So are they in the fast lane to a richer retirement or the poorhouse? Let's see what history has to say about that. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, your guide to DIY investing with insights from savvy everyday investors and financial pros. Presented to you as always by TD Direct Investing, I'm your host Rob Moise. And I've seen some chatter online about holding a 100% stock portfolio in retirement. Certainly it's a bold strategy, but what do the numbers say about it? Well, we're going to crunch those numbers to find out. And we want you to get in on the conversation during our live Q&A session. There are plenty of ways to have your say, so don't miss your chance to weigh in on today's topic and have your burning questions about retirement answered. Joining us is DIY investor and early retiree himself, Karsten Jeske. He's the founder of the popular finance blog Early Retirement Now. Karsten, it's wonderful to have you with us. We really appreciate you taking the time to join us.
Thanks, glad to be here.
I think you're like the man for the moment here, Karsten, because you spend a ton of time and effort pouring through historical data and running simulations to essentially help investors optimize their retirements. You're an early retiree yourself, though. You could be kicking it back on a beach somewhere and doing nothing. What inspires you to keep doing all the nitty-gritty number work?
Yeah, you're right. I don't have to do this anymore. I feel my retirement is pretty safe, but I just find it intellectually challenging to think about withdrawal strategies, and keeps me busy in retirement, and I stay relevant. And since I retired, I also met a lot of interesting people through my blog, so that includes you.
Oh, shucks. Well, you flatter me. Well, we appreciate that, but really appreciate you taking the time, like I said. With personal finance and retirement, obviously everybody has such a unique situation, but I'm curious what you think some of the key factors are that somebody would want to think through while they determine what the optimal, portfolio allocation is for them given their situation.
Right, so part of it is, most of it is actually personal parameters, right? How risk tolerant are you? How long is your horizon? For example, if you have a very long horizon, you really need the earnings power of an equity allocation. Whereas if you say you have a short horizon, or it's because you might have some very generous benefits starting in 10 or 15 years, you just have to bridge this gap in cash flow. I wouldn't blame you if you go all fixed income, say through a CD ladder or a bond ladder. But most people, especially the early retires, they just have to be a little bit more aggressive on the equity side to have the staying power to last you 40, 50, even 60 years. Also, what matters is how many additional cash flows do you have, right? Do you have generous inflation-adjusted pensions, and all of the basic stuff is already covered? You can definitely take more risk with your retirement portfolio if that's the case. Homeowner versus renter could be another issue, right? So again, a lot of your mandatory expenses are already covered as a homeowner. Maybe you can be more aggressive with your asset allocation, and then also how much of a bequest do you want to leave, or how much do you want to give to charities over time, right? If you want to give very generously and you want a stadium or a building named after you at your university, right, you probably have to have a more aggressive asset allocation. So all of that, and many other personal parameters, and then potentially also what is the macro situation, right? What are bond valuations? What are equity valuations? Inflation forecasts? If that is your forte, that is something that could also flow into your asset allocation considerations.
Yeah, so lots of things to juggle, of course. I will say I don't think there's an asset allocation out there that will put me on track to have a building named after me, but I'm working on it. We'll see what I can get to. One of the things, though, I find really interesting about a lot of your work is that you focus on the Shiller-Cape ratio. This is a way to value stocks as a really big determinant as to how your retirement might play out and what that optimal asset allocation might be. Can you just kind of help us understand what is the Shiller-Cape ratio and why is it so important to finding that right asset allocation?
Right, so it's a price-earnings ratio, right? And that's something that's been around in economics and finance for the longest time. But so Shiller called this the cyclically adjusted price-earnings ratio. So he takes a longer term view on the earnings, and so it takes actually a 10-year rolling average of past earnings and looks at what's today's price relative to this rolling average of earnings. So the rolling average of earnings basically smoothes out all the business cycle fluctuations, and that actually has been quite predictive for future asset returns. Not the future asset returns for tomorrow or next week or next month, but it has been amazingly correlated with longer-term asset returns, especially stock returns. And so if you look at the historical failure rates of the 4% rule, so they all happened if at your retirement date the CAPE ratio was above 20, and sometimes even significantly above 20. So it means if the way I plotted it here in the scatter plot is actually I compute 1 over the CAPE ratio, which is also called the CAPE earnings ratio, the CAPE earnings yield, I should say. So if this earnings yield was under 5%, so that means the CAPE ratio was over 20, you have an elevated risk of failures in retirement. So given today's elevated CAPE ratio, the probability of tagging on, say, another 10 years or 20 years of bull market are a little bit lower. And then likewise, if the stock market is in decline and we are at the bottom of a recession, you have a very low CAPE ratio, a high earnings yield, so you probably don't have to worry too much about the 4% rule, because the probability of tagging on another Great Depression after that is probably also very remote. So it's actually one of the few indicators that has some real predictive power in finance, and this is something that we observe today, and so we should use it.
It's fascinating stuff, and I can see a lot of retirees saying, well, wait a minute, like stock valuations are pretty high today right now, so like what does that mean for retirement? And I think that's maybe where the 100% stock portfolio in retirement idea has really kind of picked up some steam. Like I need the higher expected returns to make this work. So let's dig into that with a case study to find out, what does the historical data say about this idea? So let's say that we have a retiree, they're planning for a 30-year retirement, standard stuff. They're not interested in leaving a legacy when they pass. Essentially, they want to die with zero. They want to use the 4% spending rule as a benchmark, essentially spending 4% of the starting value of their portfolio and then adjust for inflation each year. And they want to have a success rate of at least 90%, meaning they're not going to run out of money prematurely before the 30 years is up about 90% of the time. So you have a fantastic chart that kind of explains, how things might go for them. So walk us through what we're seeing and what it says about the viability of a 100% stock portfolio under the different sort of stock valuation regimes that they might encounter.
Right. So if this is the retiree today, it's probably a little bit risky to go 100% stocks. But so what I find is that 100% stock portfolio actually works okay if the CAPE ratio is low enough, say below 20. At that point, it's probably not really that much diversification you get from bonds if equity valuations are already really attractive, which could mean that we might have just gone through a bear market. However, 100% stocks is not really that optimal when stock valuations are very rich, above 20, certainly when they're above 30, as they are today. It's actually close to 40, depending on which measure you use. And that's really the danger zone when you have to worry about sequence of return risk. So the problem with 100% stocks in retirement is that if you go through a major market downturn, this could cut the portfolio value so badly that even though obviously the market portfolio will always recover, your portfolio, which is the market portfolio but minus withdrawals, may not recover. So sometimes obviously market recovers quite quickly and you might be okay, something like in 2022 or 2020. But in the worst historical cases, like 1929 or the 1970s, early 80s, this would have been a pretty bad asset allocation looking backwards. And then obviously you also have the human aspect, right? So holding 100% stocks, you have to have some stomach to make it through these downturns, because you don't know how quickly the recovery comes. So we can always sit here as armchair quarterbacks and look through past returns, but if you are actually that retiree and your portfolio is down by 30, 40, 50%, and you don't know if the recovery is going to come right around the corner, it can actually be quite nerve-wracking. So also keep in mind this human and behavioral aspect there.
Yeah, I think on paper it might be easy to say, yeah, I'll just hold through the volatility and the stocks will bounce back and stuff like that. But when it's actually happening to you, it can be pretty scary. I think maybe some people too lured into maybe a false sense of security with how quickly we've seen stock recoveries recently. It doesn't always work out that way, right?
Right. And I mean, most recently, obviously, 2020 and 2022 were very quick recoveries. But so, for example, the dot-com crash in the US was actually a pretty gnarly event because it recovered. And right after it recovered, it was 2007, and we had the next stock market drawdown. So, so we don't even have to go back to these crazy historical examples like 1929. I mean, it's just even within the last 30 years, we've had some very deep and extended drawdowns.
Now, the example that we were looking at right there is if somebody wants to effectively die with zero. A lot of retirees might not be comfortable cutting it that close. Either they want to have a legacy that they leave, or they just want some more buffer room. Would holding 100% stocks in that case, maybe make sense for them? Just because they likely need the higher returns to preserve their nest egg. We've got some other charts too that you can walk us through.
Right. So, for example, if you have some concern about either leaving a buffer, a reserve, or a bequest, or some gifts to charity, that obviously necessitates a little bit higher equity allocation. It also means that your failure rates are obviously going to be higher, right? Because you have a more difficult to reach target. So in this case, higher equity exposure is beneficial. But again, it's not beneficial if equities are very, very richly valued. So, of course, if you have CAPE regimes, say below 15 or even 15 to 20, it no longer guarantees a success rate. So you're trading off basically failure rates and safe withdrawal rates. So in that regime, probably trading off a little bit of your safe withdrawal rate for some safety in retirement might be the better idea. So maybe lower your withdrawal rates to maybe 3.5%, and then you can do something like a 75-25. So that's probably what works best for most retirees.
Yeah, I want to pick up on that thought because if it seems like 100% stocks isn't necessarily this panacea that everybody was thinking of, what is that sweet spot, generally speaking, for asset allocation, if history is any guide?
Right. So, and again, the average outcome is obviously still best for a 100% equity portfolio. So it's basically the 75-25 portfolio, which seems to be the sweet spot if you worry about hedging the worst case scenario. So in my experience, at 75-25 is that sweet spot, It's a nice compromise position where you hedge all of the extremes. So you pick a much higher bond share. You could do better in 1929, but then some of the 1960s and 70s episodes look really bad because obviously their equities were down, but bonds too. And then vice versa, if you have a much lower bond share, then you might do a little bit better in the 70s, but it would hurt you in something like the 1929 episode, where bonds were actually a pretty good diversifier. So anywhere between 60 to 80% stocks is generally where you want to be. And then you could adjust to maybe a little bit along the way, maybe roll a little bit with the CAPE ratio. 60-40 might still look pretty good, but I wouldn't go much lower than 60-40. So again, 75-25 seems to be the sweet spot here.
One of the things, just looking at the chart, and correct me if I'm not reading this correctly, but it seems like higher bond exposure doesn't necessarily improve the safety of the portfolio and the retirement plan all that much, other than in circumstances when stock valuations are very high. Can you just explain why that is? Because we often associate bonds with safety, security, and yet the data doesn't seem to be bearing that out.
No, I mean, bonds are still the safe asset, right? So if we have a recession like the ones we had in 1929, in 2000, in 2007 and 8, 9, and also 2020, bonds were actually a very good diversifier. And now there are some cases, so for example, 2022 was a relatively shallow recession, and actually there were a few bond funds. If you had invested in something like a 30-year treasury bond, I think they had bigger drawdowns than even the stock market. So it can actually backfire, especially during an inflationary recession. And so people worry about the Federal Reserve raising interest rates. There's an inflation risk. So 2022 until today is actually bonds went through some pretty tough times. Well, the nice thing is that obviously bonds, so basically now the cows have run out of the barn. It's too late to close the barn door. So people now are bashing bonds. Is actually bond valuations now look pretty good again, right? Yields are pretty decent. And so I wouldn't blame you if you mix in a little bit of bond allocation today.
One of the things I think some viewers might be curious about is this idea of like, well, maybe I don't want to go 100% stocks right off the bat, but if there's like a market crash, does it make sense for me to dynamically, adjust my portfolio up and go 100% stocks? And what do you think about that idea?
No, I think it's a great idea, especially because I used to work in that field. When I worked at Bank of New York Mellon, I was in the department that would do these tactical asset allocation decisions. And it's a little bit difficult to get this right as a retail investor. And then also the question is, how far does the stock market actually have to fall for 100% equity allocation going forward to be optimal? And people underestimate how far that fall has to be. It's actually, historically speaking, you would have to have something like a 50% drop in the stock market. And then, yes, absolutely, then you want to go all in to the stock market. And so it's not enough to just have a garden variety drop in the stock market and then shift all into equities. So it's a probably even if we have something like a repeat of, say, 2020 or 2022, at the bottom there, obviously, in hindsight, it would have been the right time to go all in. But historically speaking, there were a few times when the stock market had a lot more to fall. And nobody knew in 2020 or 2022 how far lower we would go.
Yeah, and then there you have the human element rears its ugly head again, right? Like to actually make a move like that and pick the bottom, very difficult to do. But hey, if you could, it's something to think about maybe, and you're comfortable with it. I know some viewers are watching this and saying, well, stock valuations are very high today. You're saying, capes above, 20 or even 30, is the danger zone. Well, we see some stock valuations, particularly in the U.S., that are like 40 almost. So what does a retiree do today? Like if they want to, mitigate some of the risk of their retirement?
Right. So, of course, I don't blame you if you're still 100% equities, right? Because equities have been running pretty well recently. And just like you cannot time the trough of the market, you also cannot time the peak of the market. And so I don't blame people if they, I'm going to play this a little bit longer and see. And so also, lots of retirees, especially early retires, they probably have the flexibility to, if it doesn't work out, they can go back to work at least part-time and supplement their income a little bit. Keep in mind that not every failure is created equal, right? So for example, a failure of a 100% equity portfolio might occur a lot faster. So for example, if you look at a 30-year retirement horizon, so the portfolio is something like a 60-40 or 75-25. The failures, they're very rare, and they would occur, say, maybe after 25, 27, 28 years after you start retirement. You may not be even alive at that time, so because you're hedging probably way more longevity than you might actually have. Whereas a 100% equity portfolio, there have been some historical cohorts where the 100% equity portfolio ran out of money after something like 15 years. So obviously, you have to bring with you a lot more flexibility. And I also concede that a lot of people in the personal finance influencers scene, right, they keep 100% equities because they can afford it, right? They have some additional cash flow through their blogs or YouTube channel, but that's obviously not everybody has that luxury.
So is the idea then you have to essentially like lower your spending then if you wanted to like really give yourself a chance to make it last over the 30 years as you intend?
Right. So it's basically we have these two levers, right? Or we have these potentially two objective functions, right? One is the probability of success, and one is how much you actually withdraw, right? I mean, you could obviously lower your withdrawal rate and increase the success rate that way. I mean, the best way to have 100% success in retirement is to withdraw 0.001%. Well, of course, it would be a very comfortable retirement. And then a very comfortable retirement is you withdraw 20%, but it wouldn't be very confident. So basically, we have to walk this tightrope here where we have to balance these objectives, the probability of success, and then also obviously withdraw enough money that you really have a happy retirement.
There's an idea that I really want to bounce off of you, because we were speaking with Veronica Popova from Vanguard just a couple of weeks ago about an 80-20 portfolio. So pretty similar to your 75-25 sweet spot. But she was suggesting that international diversification in equities can help address this overvaluation risk that we've been talking about. Let's hear her rationale.
All of that together is what's going to diversify, because when one is moving up, the other is moving in a different direction, and that balance is what's going to keep retirees in the market without seeing everything drop at once, getting scared, selling it all, and then you really kind of, shot yourself in the foot at that point.
So, Karsten, I'm curious, how effective is international stock diversification actually at hedging this overvaluation risk that we're talking about?
Right. So in general, I don't want to bash international diversification too much, but I mean, we have to be realistic here, right? So the standard narrative here is that I can show you last week or 2 weeks ago, there was a day when my home index was down by 1%, but the non-US index was up by 1%. And I mean, look at that. I mean, if you had diversified, you could have hedged some of that risk. But there is really very little evidence that, say, if the US market is down 20%, that the rest of the world will be up by 20%. More likely is a situation where if the US goes through a bear market, really the rest of the world will go with us. Right? For example, 2007, 8, 9, we had a housing crisis. Even countries that didn't have a housing market crisis, right, like Australia, they still went through a bear market. And it's just because if the U.S. Goes through macroeconomic difficulties, everybody else will feel that. So I don't think that international equity diversification really gets you out of the risk that your equity portfolio will go down. I have to concede that, I mean, obviously, if you were a listener in a small country like Belgium or Australia or even Canada, right? I mean, your home index could go down. And there's nothing happening in the US, so you would actually benefit from international diversification. The other thing I want to mention here is that it is absolutely true that the American CAPE is insane, right? It's almost 40 if you look at Shiller's number, something like 35 the way I calculate it. And then there's some non-US stock markets where the CAPE is only 20. And so we shouldn't believe, though, that if the U.S. market were to drop by 50% and it brings us down to the 20 CAPE, that nothing will happen internationally. Right? So that it's very well possible that international market that currently has a 20 CAPE will fall to a 10 CAPE, that the international market will also fall by 20%. So there isn't some kind of a magic rubber band where if we have a CAPE of 40 and international market has a CAPE of 20, that boom, they meet in the middle at 30 and the US market falls and the international market increases. So I've seen cases where the US stock market dropped, our CAPE ratio went down, and CAPEs were much more attractive in other countries, but they also went down from their even affordable level, they went down even further. So it is true that during the recession and bear market, really all correlations go to 1. But I have to concede that obviously it's actually when you need the diversification the most. International diversification doesn't really give you that much diversification because all correlations go to 1. But it is true that during the subsequent recovery, it's absolutely possible that other countries and other regions and other sectors will do much better during the recovery. But I doubt that there's a lot of diversification during the initial drop. If you're really, really scared about expensive valuation in the US, I would probably diversify with bonds and not so much with international stocks.
Okay, so international exposure, not this silver bullet that solves all our problems, but it can offer some benefits for sure.
Yes.
What about gold? Because gold's kind of having a little bit of a moment right now. What kind of impact could it have?
Right, gold had this great run, has fallen a little bit from that peak, but is obviously still doing well year to date, especially over the last few years. So I did some simulations, and I found that mixing in a little bit of gold would have done well during some of the past worst case scenarios. So, the global financial crisis would have done quite well in the 1960s and 70s, would have done very well during the Great Depression. So I don't blame people if they mix in some gold. It still gives me a little bit of heartache to invest in an asset that has such a low average return, right? Because there's nothing that gold does for you. It doesn't pay interest, it doesn't multiply, it doesn't pay dividends, it doesn't create corporate earnings. It's just Warren Buffett said, right, we dig the gold out of the earth and then we refine it, then we put it back into the earth in some vault at the New York Fed or at Fort Knox. So really head scratcher how gold could have done so well. But it did have some very intriguing correlation statistics, right? Because it is both an asset that hedges against inflation, but it also did very well during some of the deflationary recessions, like the Great Depression, the dot-com crisis. And so it's definitely a very intriguing asset. The one little caveat I have is that the one decade where it absolutely performed spectacularly well, which was the 1970s, there were actually two things going on, right? Before that big run-up in prices, the gold price was essentially fixed, and the retail investors in the US were not even allowed to own and trade gold the way it is done today as almost a financial asset. They're gold ETFs, and you can buy and sell gold with the click of a mouse. And that was not possible. And then when that market was liberalized and taken off of these constraints, that's when the gold price rallied. And then it happened right at the same time when stock market and the bond market went through some problems. So there's one of these beautiful correlation there. Was that really created because gold is such a good diversifier, or was that just dumb luck that just the market was liberalized? And it just happened at the right time. But I concede, in historical simulations, gold has done quite well.
Okay, so something to consider as like a relatively moderate part of a portfolio. Great food for thought, Karsten. We appreciate you sharing all this fantastic historical data with us. Probably got some retirees thinking about maybe their next move. We got our Q&A coming up in just a moment here, but before we get to that, I just want to ask our viewers, are you enjoying the show so far? Because if you are, make sure you follow TD Direct Investing on YouTube, Instagram, and Facebook. You can see the QR codes on screen that you can scan to give us a follow, give us a subscribe, give us a like, all that good stuff, because we've got a ton of content designed to help you build your investing knowledge there to check out. Before we dive into our Q&A, I want to bring in my colleague Caitlin Cormier because she's going to show us on WebBroker how retirees can manage their retirement portfolio. Caitlin, welcome to the show. Great to see you as always.
Nice to see you too, Rob.
So tell us, what tools do we have on this platform that can help us stick to our desired asset allocation over time, whatever it may be?
Yeah, I mean, like we talked about, the market's always moving, so it's kind of sometimes hard to stay on top of what your portfolio actually looks like. And the asset allocation tool can kind of help you get a quick look in just a second as to what your portfolio breakdown is. So if we just look quickly here on WebBroker, this is going to be under the accounts section of your portfolio and asset allocation. At the very top of the screen, you're going to see this little quick snapshot that's showing you what percentage of your portfolio falls into these categories: Canadian, US, and international equities, Canadian global fixed income, and cash. And then if you move down a little further on the screen, we're actually going to get into these categories in more detail. It'll break down within each one of these categories what different securities fall under each. And then it's going to show you, what percentage of your portfolio that is. So if you're looking to do some rebalancing to make sure you're back in line, it'll give you a really quick, easy way to see where you're overweight, where you're underweight, and what securities you can buy or sell to kind of even that out.
Really handy tool, nice little snapshot there so you can kind of pick and choose what you're going to sell at whatever given time to keep you on track. Appreciate you showing us the ropes there, Caitlin, as always. That was TD Direct Investing Senior Client Education Instructor, Caitlin Cormier. All right, Karsten, it's time to dive into the questions from our viewers. Let's open the floor and take some from our viewers. We got our first one coming to us. Let's check it out. This one is coming to us from Terry, I believe. And Terry wants to know, can you explain, again, the CAPE ratio in plain layman's terms? Yes, explain it to us like we're 12, Karsten, please.
Right. So the CAPE ratio, you calculate the current price of the index divided by earnings. And so what do I use as earnings? Instead of looking at just 1 year of earnings, backward looking or forward looking, what Shiller does is he looks at a 10-year rolling time series of earnings, and what that does is it averages out over recessions and expansion, so it makes it a little bit smoother. And and of course the earnings, because you're taking 10 years of earnings, you have to inflation adjust them. So there's an inflation adjustment component there, and so it's basically it tells you how many times average 10-year rolling earnings are you paying for one share of the S&P 500 today? And of course, you can expand this to any other index. You can do this for individual stocks, but usually it's done for a country index.
Okay, so that's like a nice little, relatively layman's approach to unpacking Shiller CAPE. It's really interesting data, and it's all available online for free, actually. Shiller does a great job of making that available. Yes. Let's get to our next question. This one coming up to us from Patrick. Would you consider replacing bonds with stable utility stocks? This is a really interesting question because I've heard of investors using things, perhaps utility stocks and stuff like that, as like bond proxies. Is that a fair way to look at them, Karsten? What do you think about that?
And again, I'm not going to comment on any individual stocks, but I think you still have a ton of equity risk in that utility stock portfolio. And so if you wanted to hedge out something like a big drop like we had in 2000, 2001, 2002, 2003, or during the global financial crisis, I think bonds would be a better hedge against that equity market volatility, so you will definitely notice that your utility stocks also going to get hit if the overall stock market is down. But I can see that people find this an attractive kind of an intermediate solution instead of going full scale bonds and having that opportunity cost and moving money out of equities. That is basically, think of your utility stock as basically a 70% equity, 30% bond portfolio, and so yeah.
One of the strategies that's kind of popular here in Canada, because we love our dividends here in Canada, is living off of dividend income using things like blue chip Canadian dividend stocks. These things have been paying dividends and raising dividends for like 50 plus years. They seem unassailable at face value. Is there a risk that people are not, properly accounting for when they're using the strategy?
Right. I mean, so it basically makes you a stock picker, right? And then I have to point out some of the caveats here, right? I mean, you will not be able to outperform a market benchmark, right? Because a lot of professional investors, hedge funds, high frequency traders, and so on, they will have the same or more information than you. So it's not like you have found some super secret signal that nobody else has ever noticed, which is the dividend yield. So if you believe that dividend stocks, and even with additional screens, right? I mean, obviously you say, well, I'm not going to just invest in dividend stocks. I have some additional screening process. I only look at companies that have been paying stable dividends and have been raising their dividends for the longest time. You're not going to beat the benchmark. Right, so or at least you're not going to beat a benchmark adjusted for the risk premia and market exposure. But then again, I also don't want to hammer too much on the dividend crowd, right? I believe in efficient markets. It's not like I'm saying that you will underperform the market either. I think you will perform according to what the market demands and what equity what the equity risk premium demands for these kinds of stocks. My concern is that if you have a 100% dividend stock portfolio, that might be a little too risky, right? You may actually have almost like a portfolio that's 80% market benchmark plus 20% cash, probably behaves not too differently from the dividend income portfolio. And also keep in mind that sometimes these dividend stocks, right, they feel really safe and they have a long history. But Lehman Brothers also paid dividends and raised their dividends all the way until 2007, until it went out of business. The other thing is that you have a potential lack of diversification, right? First of all, the lack of diversification internationally, right? Because Canada, if you look at only Canada, you are probably missing out on a lot of other countries and sectors, right? So Canada is very overvalued. Very tilted towards obviously utilities, materials, the energy, and also finance. And America the United States is more tilted towards technology and communications and healthcare. And where do I think is the growth and the big productivity gain going to come from in the future? Right? I mean, we're all getting older, so I think I like healthcare. So that's one reason why I like the U.S. index, and then also I think a lot of exciting stuff is happening in technology. But then again, I don't want to say that this always has to outperform, right? As I believe in efficient markets, I think the expected returns are probably going to be roughly they're going to be fair. And I'm not saying that you're going to underperform necessarily, but you might have some unknown and unnoticed risks. And then also, and again, I'm not a tax planner. Dividend stocks might be tax inefficient, so you have to check with your tax advisor. And I always say check your local listing. So see if that applies to your particular situation. I like stocks that don't pay dividends, and then when I want to generate a cash flow from my portfolio, I pick which tax lot I'm going to liquidate for that, right? And in a year when I don't want to have a lot of taxable income, I take the ones that have the high cost basis. And then in some other years, I have maybe some of my other income is lower, then I can afford to liquidate some of the higher capital gains tax lots. So it's I like the planning that I can do with my capital gains. And whereas the dividends, they're dropped on you, and there's very little I can plan for that.
Okay, so some food for thought for dividend investors thinking that they found a cheat code. Not quite exactly. There's risks to consider. Let's get to our next question from John. John's got one for us. Besides bonds, do you include ETFs in the 25% portion of the 25-75 portfolio split that you mentioned?
Besides bonds, so yes, I mean everything I do is basically ETFs. I personally have relatively little individual stocks, and so it's all ETF or mutual fund based. Yeah.
Mm-hmm, okay, so ETF can be a bond ETF, could be a stock ETF,
yes,
could be anything. Yeah.
Right, exactly. So that is so ETF. One is the legal structure, and one is the asset allocation. And now it used to be that ETFs used to be more of an equity passive index fund. I once heard the stat that we now have more ETFs than individual stocks in the United States, which is kind of insane. But just because this is how many flavors of ETFs we have now.
Mm-hmm. Yeah, I've heard that stat too. It's pretty mind-blowing, the growth of the industry in a pretty short time. Sukhdeep's got a question for us. Let's get to his. What percentage of your portfolio is allocated to Asian or other international stocks?
I think I have, and I have to admit this, I'm very embarrassed. I have only about a 5% allocation to international stocks. And that's all of international. So that includes Europe, obviously, too. So I'm actually quite undervalued Asian stocks, unfortunately.
Okay, so sticking with your U.S. Country home bias there. Okay, but that's all well and good. Let's get to our last question. This one's coming to us from Nimesh. If someone is 100% invested in stocks, do you recommend diversifying across industries, or could you just go heavy into the one that you think is going to perform the best?
Right. So yes, you absolutely have to diversify across industries. I mean, 100% stock portfolio is already a little bit on the risky side, even though, I mean, I gave you some examples where this could work. Yes, you absolutely want to diversify across different industries. You shouldn't all be in technology. And by the way, you shouldn't completely avoid technology either, right? Because the risk is that you're being left behind there. Yeah.
It always comes back to diversification, I find, in almost any conversation I have. It's like the only free lunch in investing, right? So it's hard to get away from that. But in any case, appreciate you fielding all those questions from our viewers, Karsten, and kind of sharing the historical data with us. It's fascinating stuff. I admit some of those charts are a little bit hard to wrap your head around when you first see them, but when you dig into them and you really understand what they're saying, the insights are incredible. We'll have to have you back on again to show us more of the incredible insights that you have. But really appreciate you joining us this time.
Yeah, I got a lot of time. Thank you.
Okay. And for those in our audience, of course, thank you for tuning in as always. Make sure you check out next week's episode because we've got early retiree Mark Seed sharing the investing moves that helped him retire in his early 50s. Might help you do the same. That's all the time we have for this edition of the program. For everyone at Inside Investing, thanks again for watching. See you all next time.
Have more questions? Check out the links to the right and in the description below.